Welcome to your deep dive. We're tearing through the latest market intelligence briefing today, October 9, 2025. Our mission here isn't about the daily price swings, no. We're charting the bigger picture. The market's shift towards institutional dominance, and, crucially, how this structural demand seems to be building a much higher price floor.
That floor is absolutely the story right now. We're seeing remarkable stability, really consolidating near that recent all-time high, trading, pretty solidly between $121,200 and $124,200.
Okay.
But what's really important for you to grasp is the tension here. On one hand, massive persistent spot demand. That's giving us real stability.
Right, structural stability.
Exactly. But on the other hand, you've got rising leverage and derivatives. So while the fundamentals look sound, we do need to watch out for, let's say, speculative overheating.
Okay, so let's unpack that structural demand, that bit, because the news, it really feels like the changing of the guard is well done.
It certainly looks that way.
The biggest thing seems to be the formal entry of sovereign and institutional capital. It's setting up a completely new demand profile, isn't it? Something we haven't seen before.
Absolutely. And nothing screams validation quite like the move from Luxembourg's Intergenerational Sovereign Wealth Fund, the FSIL.
Okay, tell us why Luxembourg is such a big deal here.
Well, they've officially put 1% of their, massive holdings into spot Bitcoin ETFs.
1%. And they're the first state-level sovereign wealth fund in the Eurozone to do this.
The very first. And the sources break down how they did it. Basically, a framework revision allows up to 15% in alternatives now.
Okay.
With a specific, deliberate 1% carve-out just for crypto. Small number, but specific.
Right.
The significance, though, it goes way beyond just the money. This move dramatically lowers what we call career risk.
Career risk. Explain that.
Think about it. Before this, if you were managing a pension fund or state money, being the first mover into Bitcoin, even a tiny bit, that was risky for your job.
Yeah, stick your neck out kind of thing.
Precisely.
Oh.
But now, Luxembourg, a respected, regulated European financial center, they've provided the political cover, professional cover too. So the internal chat inside any conservative fund in Europe, or frankly, anywhere, it just flips.
And so?
It goes from, should we risk being the first ones in crypto, to the much easier question, why aren't we following the precedent, the safe path set by Luxembourg? It's like the start of a cascade, a compliance-approved one.
And those institutional flows, they're just flooding into these ETFs. We have to talk scale here. BlackRock's IBIT. It just blew past 800,000 Bitcoin under management.
It did. Just over 802,000 BTC, actually.
Yeah. Wait, that single product holds?
Yeah.
Oh, how much is that of the total supply?
It's 3.8% of the maximum possible supply in one ETF.
That's incredible.
And just for context, IBIT alone now holds more Bitcoin than the biggest corporate treasury out there, which is around 640,000 BTC. Things are moving fast.
So, okay, 3.8% of all potential Bitcoin basically locked away in institutional vaults. What does that actually do to the market mechanics?
This is what we mean by the institutionalization of a supply shock. We used to focus on the halving, cutting, minor supply.
Right, the scheduled shocks.
Exactly. But now you have financial products, just one in this case, systematically hoovering up thousands of BTC from the available supply every week. Minor supply is fixed, it's decreasing, this institutional demand, it's huge and it's sticky. So as the pool of Bitcoin that's actually trading shrinks, the market gets thinner. Order book depth goes down. Meaning the market gets much more sensitive. In the future, even smaller amounts of new money coming in could cause really big, disproportionate price jumps to the upside.
Which makes the current stability even more interesting because this demand isn't slowing down. The whole spot ETF market, 8 straight days of positive inflows now.
8 consecutive days. Pulled in over $5.3 billion in new capital just in that stretch.
Wow.
And this consistent buying, it just confirms that changing of the guard idea we see so clearly in the on-chain data.
Okay, explain the on-chain picture.
So long-term holders, LTHs, we call them basically, early folks taking profits. They've sold off or distributed about 295,000 BTC in the last month.
That sounds like a lot of selling pressure. Historically, that would hurt the price, right?
Absolutely. In past cycles, that much selling would have crushed the market. But this time, it's been completely absorbed. And the price floor actually rose through it. This tells us we're in an institutionally paced bull market. Early sellers are handing off their coins to deep-pocketed institutions, and that whole process is building a much stronger, higher floor price.
So we have Bitcoin being locked up as a reserve asset. That's one kind of utility.
Right.
But what about actual use? Companies using it for, transactions. Let's shift focus a bit to utility. How does that add to the stability?
Yeah, the corporate playbook is definitely moving beyond just sticking it on the balance sheet.
Okay, like in Japan, this alliance looks huge. Massive payment provider, 70 million users taking a 40% stake in Binance Japan.
Right. And this isn't just a financial investment, it's strategic. They specifically want to build a seamless fiat to crypto bridge.
Meaning,
Meaning PayPay users can buy crypto directly using their regular PayPay money balance. It removes all that friction,
okay, makes it easy.
Super easy. It merges this giant existing Web 2 user base with Web 3 rails. And in a place like Japan, that adds a ton of legitimacy. Political capital, too.
And then back in the US, you have Block Square launching Square Bitcoin, aimed right at their merchants.
Yeah, over 4 million U.S. merchants, though not in New York yet. They're trying to bring Bitcoin into everyday commerce.
And how are they doing that? What's the hook?
Well, they're making it really easy to accept Bitcoin payments starting November 10th. But the kicker is the fees.
Okay.
0 processing fees until 2027, then just 1%.
Wait, 0 fees. How does Square make money on that? Is it just about getting users or?
It's definitely a long game, strategic play. They eat the transaction costs now to get merchants comfortable, onboard the crypto-curious ones,
Right.
But they're betting on another feature. Merchants can choose to auto-convert up to half their card sales into Bitcoin.
Ah, okay. So Square holds the Bitcoin.
Exactly. That feature alone pulled in a 142 BTC just in the beta test. So Square builds its own treasury, earns yield perhaps, while making the initial transaction free. They capture the long-term capital flow.
And this treasury model itself, it's going global,
Yeah.
right? Not just U.S. companies. We see French fintech Tractel.
Yeah, Tractail.
Yeah.
They're buying their Bitcoin 26 BTC or so straight from operating cash flow, not borrowing, not issuing stock for it, just business profits.
It feels sustainable.
It does. And then you've got UK-based BHODL. They have 136 BTC, but they're looking at using it productively, building out Lightning Network infrastructure with it.
So not just holding, but building on the holdings.
Exactly. The idea is maturing. It's becoming HADL and build.
And Wall Street, or maybe the broader capital markets, seem to be buying into this.
Yeah.
DDC Enterprise, listed on the NYSE, just raised $124 million in equity,
Led by institutional investors, yeah.
specifically for its Bitcoin treasury strategy.
And that's huge validation. It proves this Bitcoin accumulation vehicle model works for public companies. Institutions are funding the strategy directly. It confirms there's a new subsector emerging. Public firms valued partly on how well they acquire and manage Bitcoin. That adds yet another layer of steady managed demand.
Okay, shifting to the bigger picture, the macro backdrop. We've got the U.S. government shutdown, day 9 now, still no deal. And geopolitical stuff heating up China's new rare earth export controls.
Using those economic choke points.
How does this feed into the Bitcoin narrative?
Well, these kinds of actions, they chip away at global trust. Trust in centralized systems, both political and financial. When major powers start weaponizing payment networks or critical supply chains, well, other players start looking very hard for neutral alternatives, things that can't be seized or controlled easily.
Right.
And that really elevates Bitcoin's potential, not just as digital gold, a store of value, but potentially as a kind of digital SWIFT, a neutral settlement layer, especially for trade between countries that maybe don't trust each other.
And at the same time, we're seeing regulators provide more clarity, which lowers the risk, right? Again, helping build that floor. Big news out of the UK.
Huge news. The FCA, the Financial Conduct Authority, they just lifted their 4-year ban on selling crypto ETNs, exchange-traded notes, to retail investors.
Okay, ETNs, not quite ETFs.
Yeah.
But similar access for retail.
Similar idea, yeah. ETNs are more like unsecured debt notes tracking the asset, but lifting the ban is massive. It could potentially allow these products into very conservative tax-advantaged accounts.
Yeah.
Things like ISAs and SIPPs in the UK.
And those hold a lot of capital.
Collectively, nearly $1 trillion. So the UK is basically signaling, okay, regulated access is fine now. That opens the door for very conservative retail money.
And Europe's moving too.
Yeah.
Ahead of the big micro-regulation rollout.
Yeah, the European Banking Authority, the EBA, just put out a report tackling money laundering risks.
Why is that important now?
It provides a harmonized framework. Banks needed that clarity. Clear pan-European rules on AML, anti-money laundering and counter-terrorist financing before they could really get comfortable offering services to crypto companies. This report helps grease the wheels for banks to engage. Better liquidity, better access for everyone.
And it's not just developed markets getting clearer rules. We're seeing moves in Ghana, Kenya.
Exactly. Ghana's got a new virtual assets bill. Kenya's VASP bill is moving forward. It just shows this normalization is happening globally. Emerging markets are building proper on-ramps, too.
It feels like regulated access is really replacing that kind of Wild West speculation phase.
That's a good way to put it.
Okay, but there's always another challenge, right? A new kind of risk seems to be popping up as the network matures, specifically around mining. It's moving beyond just the energy debate now into local quality of life stuff, like noise.
Yeah, this is a classic case of an industry needing to earn its social license to operate, and we're
Yeah.
seeing it play out right now in Hood County, Texas.
What's happening there?
Residents are actually trying to incorporate a brand new city called Mitchell Bend,
Incorporate a city. Why?
specifically so they can pass a strict noise ordinance targeting a Marathon digital mining facility nearby.
And the noise is that bad. The sources mention locals claiming health issues.
Yeah, things like migraines, hearing loss. From what they describe as a constant roar from the cooling fans, they feel they have to create a new municipality because Texas counties often don't have the power to set those noise limits themselves.
So what does this mean for the mining industry, for investors?
It means the game is changing. Miners can't just chase the absolute cheapest power anymore. They have to factor in the cost of managing their physical impact. That means serious soundproofing, better site selection, way away from people. If they don't get that social license, the cost is lawsuits, forced shutdowns, relocations. It adds this new, very local layer of operational risk. And it brings that whole ESG debate down from theory to, well, noisy reality.
Okay, let's tie this all together for you listening. The main takeaway from today's briefing really seems to be this. The market is building a higher price floor, and it's being built by persistent, structural, institutional demand. This isn't retail FOMO this time. It's institutions consistently absorbing the profit-taking from earlier investors.
Precisely. You've got sovereign funds dipping their toes in, like Luxembourg. You've got mass adoption plays like Square and PayPay creating real transaction utility. And then you have this wave of global regulatory de-risking, like in the UK and Europe. It all means the asset is fundamentally shedding systemic risk faster than it's adding speculative froth. That structural de-risking, that's what creates the potential for long-term stability.
All right, so here's the final thought we want to leave you with today, really building on that Luxembourg news. We saw them make a small 1% allocation using an ETF, a managed product, right? Bypasses all the internal hassle of holding Bitcoin directly. So what happens when the world's pension funds, which manage vastly, exponentially larger pools of very conservative money than sovereign wealth funds, what happens when they start following that same small, easy 1% allocation blueprint using ETFs? The potential for consistent structural demand there, oh, it's absolutely staggering to think about.